When we talk about risk in investing, what's the first thing that pops into your head? For most people, it's simple: losing money. But what if I told you that the thing we're all so scared of isn't actually the real danger? We're going to dive into that because getting this right is literally the difference between long-term success and, well, failure.
And that fear, it's a really powerful force. I mean, just look at this number. A 2024 survey from the World Economic Forum found that a whopping 40% of people, 40%, avoid investing altogether. And why? Because they're terrified of losing their money. It just feels safer to sit it out, right?
But, and this is the big question for today, what if we're all fearing the wrong thing? What if, in our rush to run away from this big, scary monster we think we see, we're actually walking right into a much more dangerous, hidden trap?
All right, to figure that out, we have to start by unmasking the great imposter in the world of investing, and its name is volatility. This is the one thing most people confuse with actual risk, and let me tell you, that little mix-up can be incredibly expensive.
Okay, so this right here, this is the whole game. On one side, you've got volatility. Think of it as the market's background noise. It's always there, it's sometimes uncomfortable, and you can't avoid it. But on the other side, that's permanent loss. That's the real danger. And here's the absolute key. Permanent loss isn't something that just happens. It's almost always the result of a decision you make. Getting this one distinction right is what separates the pros from the amateurs.
So you might be asking, why does everyone get this so wrong? Well, you can kind of blame the textbooks. See, a lot of this confusion comes from the world of academic finance. When they built something called modern portfolio theory, they needed a number to plug in for risk, and the easiest one to measure was volatility. So they just used that as a stand-in, and ever since, people have just treated them like they're the same thing.
But here's the thing. If you step out of the classroom and talk to the people who've actually made fortunes in the market, the legends, they'll tell you that whole academic definition is just plain wrong. They have a much more, real-world view of what risk truly is.
And it doesn't get more direct than this. The late, great Charlie Munger, genius partner to Warren Buffett, he literally called the idea of using volatility to measure risk nuts. Just nuts. For him, it was a classic case of academics focusing on what's easy to count instead of what actually counts.
And another legend, Howard Marks, he puts it perfectly. He says, think about it. No investor in history has ever actually said, "Oh no, I'm so scared of the volatility," right? Of course not. What they're really truly afraid of is losing their money permanently.
So let's put a pin in this. When the greats, Munger, Buffett, Seth Klarman, when they talk about risk, this is what they mean. It's not about the bumpy road. It's about the odds that your car goes off a cliff and you can't ever get it back. It's the probability and the potential amount of a permanent loss of your capital.
Okay, so if volatility isn't the bad guy, then what is it? This is where we need to totally flip our thinking. We have to stop seeing volatility as a flaw in the system and start seeing it for what it is, a feature.
Seriously, think of it like this. Volatility is the price of admission. It's the ticket you have to buy to get into the theme park of long-term growth. I mean, if the market just went up in a perfect straight line every single day, why would you get paid more for owning stocks than for holding cash? You wouldn't. The ups and downs, the bumps, that's exactly where the opportunity for higher returns comes from.
But if it's just the price of admission, why does it feel so gut-wrenching sometimes? Well, the answer comes down to our own psychology. There's this powerful bias that behavioral scientists call myopic loss aversion. And it's basically a two-part mental trap that makes volatility feel like a real, immediate threat.
So let's break that down. Part one is loss aversion. All the research shows that the pain of losing, say, $100 is about twice as powerful as the pleasure of gaining $100. We are hardwired to hate losing. Part two is myopia. It's just a fancy word for being short-sighted. So when you combine those two, when you check your portfolio every single day, you're basically torturing yourself with these small, painful losses over and over, which makes you way more likely to freak out and do something impulsive.
And check this out. This shows you the real-world cost of that behavior. They did this amazing experiment with professional traders. They split them into two groups. Group 1 got to see prices tick by tick all day long. Group 2, they only got updates every 4 hours. Now, what do you think happened? The group that saw less information, the ones who weren't glued to the screen, they actually made 53% more profit. 53%, it's incredible. Sometimes what you don't know really can't hurt you. Okay, so this brings us to the really practical part. If volatility isn't the thing we should be worried about, How do we actually manage the thing that does matter, the risk of losing our money for good?
Well, the very first thing to get is that risk isn't some number out there in the world. It's deeply personal. The real risk isn't just about the stock or the bond, it's about how it matches up with you. What's your time horizon? Can you actually handle seeing your account drop without panicking? What's your financial situation like? Those things are what determine if something is truly risky for you.
And that leads us to this. This is maybe the most important sentence you'll hear today. A market downturn is temporary. A loss on your screen is just paper. The market doesn't make that loss permanent. You do. The single act of selling when you're scared, that's what turns a temporary dip into a permanent scar on your finances.
So at the end of the day, handling all this comes down to having the right mindset. It's about shifting how you think. Let's look at the difference between how a novice thinks versus how a successful long-term investor thinks.
Yeah, this lays it out perfectly. The novice investor is like a passenger in the back seat, freaking out at every bump in the road. They're scared of daily price moves, they're glued to the headlines, and they react to every bit of volatility. But the real investor, they're in the driver's seat. They're not scared of bumps. They're scared of their own bad driving, of poor discipline. They focus on what they can control, and they see volatility not as a threat, but as an opportunity. It's a totally different game.
And that's really the bottom line, isn't it? True safety in investing doesn't come from finding some magical investment that never goes down. It comes from controlling the one thing you can, your own behavior.
So let's just completely reframe this whole thing. The goal isn't to eliminate risk. That's impossible. Every choice has a risk. Holding cash, you risk inflation eating it alive. Not investing at all, you risk never reaching your goals. So the real question isn't, how do I get rid of risk? It's, which risk am I willing to take on to get where I want to go?
And that brings us right back to where we started. Volatility is temporary. It's just the price you pay. But permanent loss? That's a choice. One is unavoidable. The other is optional. And knowing the difference between the two, well, that changes everything.